This video is all about how to diversify your portfolio, using real estate. You can diversify your risk with the use of real estate investment trust. Actually, it's a smart investment strategy. So diversifying your stock portfolio with real estate investment can help reduce risk and increase long-term return by providing exposure to different asset classes that can respond differently to market conditions. There's no correlation when it comes to response to market conditions. So it's very important you diversify away from stocks. You may consider real estate investment trust and probably mutual funds and other asset classes. So here are several ways to incorporate real estate into your investment strategy. So how do you incorporate real estate into your strategy? Number one is invest in a real estate, investment trust. So in this case, you may consider equity real estate investment trust. So these REITs, invest in and own physical properties such as office buildings, retail spaces, apartments, complexes, and even industrial properties. And so by investing in equity REITs, you gain exposure to real estate sectors without the need to directly own or manage any property. So it's a kind of hands-off, approach to investing. So equity REITs typically offer dividends, making them attractive for income-focused investors. Let's look at mortgage REIT. Mortgage REIT. So these REITs, invest in real estate debts such as mortgages and mortgage-backed securities. Mortgage REITs generate income through the interest on loans, and they tend to perform well when interest rates are stable or rising. However, they are more sensitive to interest rate changes, compared to equity REITs. Now, the other one is hybrid REITs, hybrid real estate investment trust. These REITs combine the features of equity and mortgage REITs. Investing in both properties and mortgages, they combine the two. So hybrid REITs offer a balanced approach to real estate investments, providing properties for both capital appreciation as well as some income generation. Number two is direct investment in real estate. Direct investment in real estate. So in this case, you may consider real estate crowdfunding. Real estate crowdfunding. So platforms like Fundrise or Realty Mogul, allow individual investors to pool capital and invest in real estate properties, such as commercial properties, residential development, and loans secured by real estate. So this platform, often have lower minimum investment requirements, making it easier to diversify into real estate with relatively small capital. The next one is real estate syndication. Real estate syndication. This is a partnership where investors pool their money to invest in a large real estate project. Syndication typically involves commercial real estate or large residential properties. These opportunities are usually more accessible to accredited investors, but some platforms may offer syndication opportunities to non-accredited retail investors as well. Number three is real estate mutual funds and ETFs. Real estate mutual funds and exchange traded funds. Please subscribe to this channel and like this video. So real estate, mutual fund. These funds invest in a portfolio of real estate stocks, including REITs and other real estate related companies. They invest essentially on stocks related to real estate. They provide diversification across different types of real estate, such as residential, commercial, and industrial properties, and allow you to invest in real estate without the need for individual stock selection. Simply buy these mutual funds or ETFs, and you are already a real estate investor. And you have real estate exchange traded funds, that's the ETFs. We've considered the mutual funds. We now want to consider real estate, exchange traded funds. They are quite similar to mutual funds actually. So the ETFs hold a diversified portfolio of real estate stocks or REITs, but they trade like stocks, on the exchange. You can buy and sell them the way you buy or sell stocks in the market. So REITs, ETFs can provide broad exposure to the real estate sector with lower fees than actively managed mutual funds. Number 4 is you add real estate to your asset allocation strategy. Add real estate to your asset allocation strategy. Strategic allocation. You consider strategic allocation. Determine how much of your portfolio you want to allocate to real estate, based on your investment goal, your risk tolerance, as well as your time horizon. So real estate typically serve as a long-term growth and income generating asset class. Investors may choose to allocate anywhere from 5 to 20% of their portfolio to real estate investments, depending on their preferences as well as their goals. Then you consider rebalancing. So over time, market fluctuations will affect the weight of real estate as investments in your portfolio. Periodically rebalance your portfolio to ensure that your real estate allocation remains in line with your target allocation. Number 5 is consider the benefits of real estate in your portfolio. Consider the benefits of real estate in your portfolio. There's that benefit of low correlation with stocks. They don't really correlate. They don't respond in the same way to market conditions the way stocks do. So real estate investment often have a low correlation with stocks, meaning they may perform well when stock market is struggling. This can help smooth out the volatility of your overall portfolio and then reduce your risk level. Then there's income generation. So real estate investment trusts and direct real estate investment can provide consistent income through dividends or rental payments, which can in turn be reinvested or used to supplement your cash flow. There's number 6, geographic diversification. You can diversify away from your home country, from your country of residence. You could diversify by buying into international real estate. You also have sectoral diversification. You can diversify in different sectors of the real estate market. So the more you diversify, the better, for your risk profile. And it might also, improve your returns at the end of the day.